Canada is gaining more control over its oil, and the United States is starting to feel the impact. What once gave American refiners a strong advantage is slowly disappearing, helping Canada earn more while making life harder for US buyers. The real shock is that this shift could reshape the energy trade for a long time. For decades, Canadian heavy crude had one practical customer. Nearly all of Alberta's oil production moved south through existing pipeline connections into American Midwest and Gulf Coast refineries, with no meaningful alternative route to any other market. That captive export relationship forced Canadian producers to accept a persistent discount against global benchmark prices. Western Canadian Select routinely traded $20, $25, and at various points $40 per barrel below West Texas Intermediate. Not because Canadian oil was inferior, but because Canadian producers had nowhere else to send it. The Trans Mountain expansion changed that. And the numbers documenting how much it changed in its first full year of commercial operation are the ones American refiners are now working through. The Trans Mountain expansion entered full commercial service in May 2024. The expanded system carries up to 890,000 barrels per day of crude oil, from Edmonton, Alberta, to the Westridge Marine Terminal in Burnaby, British Columbia. A total increase from the original pipeline's approximately 300,000 barrel per day capacity. The Canada Energy Regulator documented the immediate structural consequence. TMX eased pipeline constraints on Western Canadian egress and increased exports to overseas markets in a pattern that was visible within the first months of commercial operation. Tanker liftings at Westridge increased from approximately 5 per month before the expansion to approximately 35 per month in the months following commencement of service. Those 35 tankers per month are loading Alberta crude and heading across the North Pacific to buyers in China, South Korea, Japan, India, and Taiwan. China became the largest buyer of Canadian crude shipped through the Trans Mountain system, according to reporting on the first year of the pipeline's commercial operation. That development, Canada's largest overseas crude customer being China, reached through a Pacific pipeline, did not exist in any form before May 2024. It is a direct product of the infrastructure built over 8 years and 34 billion Canadian dollars of capital investment. American refiners who had expected the expanded Trans Mountain system to deliver larger volumes of Canadian heavy crude to West Coast facilities found that a significant share of the new barrels was instead being shipped across the Pacific. The expected increase in American supply from the expanded pipeline did not materialize as anticipated because the Asian market was absorbing the new volume. Trans Mountain's own commercial framing of why Asia matters is documented on its website. The Asian market's size, its sustained growth trajectory, and the specific refining configurations prevalent in Northeast Asian refineries, which are built to process heavy, sulfur-rich crude grades similar to Western Canadian Select, make Asia a natural commercial destination for Alberta's oil. Japanese and South Korean state-owned and private refiners have long sourced heavy crude from the Middle East for exactly those same refinery configurations. Canadian heavy crude arriving on the Pacific by tanker is a direct commercial substitute for Middle Eastern supply at comparable cost and comparable quality. Every barrel Canada ships to Asia is a barrel priced against Brent, rather than at a discount to WTI, generating additional revenue for Canadian producers that did not exist before the pipeline. The WCS-WTI differential that historically reflected Alberta's landlocked export constraint narrowed measurably following the TMX's entry into service. Before May 2024, the differential averaged approximately $20 to $25 per barrel across most months. By the second half of 2024, the differential had compressed to approximately $12 to $15 per barrel, as Pacific access created genuine competitive market conditions for Alberta crude. Each dollar of differential improvement on Canada's total oil sands production of approximately 3.3 million barrels per day represents approximately $3.3 million in additional daily revenue to Canadian producers, approximately $1.2 billion annually per dollar of differential improvement. A $10 per barrel improvement from the pre-TMX baseline is approximately $12 billion in additional annual producer revenue, generated not by producing more oil, but by accessing better priced markets. American West Coast refiners are the segment of the American refining sector most directly affected by the shift in how TMX-enabled volumes are being allocated. Refineries in California, Washington, and Oregon were built with configurations that can process heavy crude, and many had anticipated that the Trans Mountain expansion would provide increased access to Canadian supply at lower transportation cost than crude arriving by tanker from Latin America or the Middle East. That expectation has been partially disappointed. The Canadian barrels flowing through Westridge are being loaded onto tankers headed for Asia at prices that reflect global Brent-linked market competition, not at the price levels that West Coast refiners had modeled when they anticipated receiving a larger share of TMX volumes. The trade conflict dimension adds a layer to the competitive dynamic that the commercial numbers alone do not fully capture. By May 2025, the U.S. tariff regime on Canadian goods, including the 10% IEEPA tariff on non-CUSMA compliant Canadian imports, and the Section 232 measures on steel and aluminum had contributed to a broader commercial reorientation in which Canadian businesses and the Canadian government were actively seeking to reduce economic exposure to the American market across multiple sectors simultaneously. The oil sector's TMX-enabled diversification predates the 2025 tariff escalation, but the trade conflict has accelerated the commercial logic of continuing to build Asian customer relationships, rather than defaulting to American buyers whenever surplus capacity exists. China's emergence as the top buyer of TMX shipped crude by May 2025 was not purely a geological or commercial outcome. It reflected a bilateral commercial environment in which Canadian producers had active reasons to develop non-American buyers. The Carney government's pipeline ambition extends the TMX logic further. The May 15, 2026 Carney-Smith Implementation Agreement targets a national interest designation for a 1 million barrel per day West Coast oil pipeline by October 1, 2026. If built, that pipeline would add export capacity equivalent to slightly more than the entire Trans Mountain expansion on top of the existing TMX system, bringing total Pacific Coast oil export capacity above 1.89 million barrels per day from a current Alberta production base of approximately 3.8 million barrels per day. Half of Alberta's production moving through Pacific infrastructure would permanently alter the commercial structure of the Canada-US oil trade in ways the WCS-WTI differential data has already begun documenting. The United States remains Canada's largest overall crude oil customer by a wide margin. Approximately 60% of American crude oil imports come from Canada, and American Midwest and Gulf Coast refineries built around processing Alberta heavy crude cannot easily substitute alternative feedstocks. That physical infrastructure dependency creates a floor below which American purchases of Canadian crude will not fall regardless of what Pacific pipeline capacity is built. But the ceiling that American buyers had previously enjoyed, the ability to set the marginal price of Alberta crude because Canada had no alternative buyer, has been removed. Competition from Asian buyers for every barrel that can reach Westridge is the new permanent commercial condition under which American refiners source Canadian crude.